Hello, this video is about how does debt financing work. It is one of my lectures, my course, Basic Accounting for Business. When a company raises money by selling debt devices, most commonly in the form of bank loans or bonds. What is debt financing? A company raises money by selling debt instruments like bank loans or bonds. It's a type of financing known as financial leverage that results in a company making a promise to pay back the incurs the cost of interest. Then the company can use the borrowed money to pay its capital expenditure or use that for working capital. Usually a well-established business that has constant sales, tight security and profitability depends on debt financing. The new startup that face insecurity in the business in the future or higher profitability also with a lower credit rating will look for equity financing. Why do the companies choose debt financing? It is easier to plan your payments with debt financing as you know your monthly or quarterly installments. Therefore, you can easily prepare your budget accommodating this payment as a regular expense. Debt financing options. Bank loan. The common form of debt financing is a bank loan. Banks will often assess the individual financial situation of each company and offer loan sizes and interest rates accordingly. Bond issues. Another form of debt financing is bond issues. A traditional bond certificate includes a principal value, a term by which repayment must complete, and an interest rate. Individuals or entities that purchase the bond then become creditors by loaning money to the business. Family and credit card loans. Other debt financing means taking loans from family and friends and borrowing through a credit card. They are familiar with startups and small businesses. It would help if you are ready with the necessary documents in the event. They want to ensure the viability of your business. Debt financing over the short term. Entrepreneurs use short-term finances to purchase inventory and other day-to-day running expenses to cover their working capital shortage, including wages and maintenance expenses. The loan prepayments typically take within a year. Short-term financing helps businesses that struggle to maintain a positive cash flow. Their expenses are higher than income, but are secure with collateral. Debt financing over the long term. Long-term debt financing is for businesses that want to purchase land, buildings, and machinery, but whatever they are buying goes with the loan as collateral. The repayment of loans usually goes up to 10 years with a fixed interest rate and obvious monthly payments. Advantages of debt financing. Preserve company ownership. You will not lose ownership unlike equity financing. It would help if you sold shares to investors who retain the business's equity position. Then they get shareholder voting rights and the owner receives reduced ownership. Debt capital is making the loan payments back to the lender with the interest, and once that finishes, the complete ownership remains with the owner. Tax deductible interest payments. The interest payments you make on the loans are deductible from the tax, reducing tax liability. The principal payment and the interest are the same and paid a regular amount, which helps to make financial decisions like setting a budget and financial planning. Disadvantages of debt financing. The need for regular income. The business owners need to ensure that the business is making enough income to cover their commitment of paying back the loan, the principal payment and the interest. The lenders want the business to post their assets as a security to save them from losing the money if the company cannot make enough money to pay back the principal and the interest as agreed. Adverse impact on credit ratings. If the business fails to pay back the loan installments on time, could affect its credit rating and harm the company in the long run. It will become impossible for future borrowings. Potential bankruptcy. When the business owner gives the assets as security, the lender could face many issues later if the borrower could not pay back the loan and might come to a stage of losing the business as personal assets. I hope you liked this video and understood the consequences of debt financing. Thank you very much for watching my video. Thank you. Bye for now. I'll see you in the lecture.